now we want to turn to a really important issue for so many of our viewers, and that are the banks and how they get regulated down in Washington. And for that, we turn to the person who really is the Dean of Washington Regulatory Law. He's Rodge Cohen, Senior Chairman of Sullivan and Cromwell. Rodge, thank you so much for being with us. Happy holidays to you. Let's look forward to next year and what you would anticipate for the banks. What is likely to come out of Washington? And let's start with the Treasury market, because there was a lot of talk about the Treasury market this year and whether it was, if not broken, at least being under some strain.
So, David, first of all, best for the holidays to you. I agree starting with Treasuries is the right place, because there is no element of our financial system which is as important. This is important to the U.S. as a world leader. It is important to the global economy generally, because Treasuries are the ultimate source of financial stability and strength. And as you correctly point out, there have been hiccups, and maybe a bit worse than that, in the Treasury markets. So I would foresee a concerted effort by the government to try and shore up that market, make sure there's sufficient liquidity, and make sure there's sufficient stability.
So there are two issues there, at least that I hear, Rodge. One is there enough liquidity? And it's a question of exactly who's holding the Treasuries, how long are they holding for. Another is transparency, which is terribly important, because as I understand it, a fair amount of the market has moved out of the regulated banks and the broker-dealers into areas like hedge funds we may not know as much about.
Right. And those two terms, transparency and liquidity, I think are inextricably intertwined. The more transparency you have, the more liquidity I think you will ultimately have. And I think it would be the right approach to resist what I call the siren song of more regulation. But what there does need to be is more information and more disclosure. It doesn't have to be public disclosure, but the Treasury Department, the SEC, the Federal Reserve, they all need to know where those treasuries are held and where derivatives for those treasuries are held. The UK found out that if you don't quite understand where gilts are held, there's a potential problem, and we should learn from that experience with the pension plans there and really bolster the disclosure here.
What about the way that the trades are cleared? Do we need central clearing?
In my view, absolutely. That is the ultimate goal, should be the ultimate goal. Central clearing is not without its issues, because you need to have backup mechanisms to make sure that if there are fails, what will happen. But a robust central clearing approach would make enormous sense for Treasuries.
One of the things we've heard from a lot of the big banks throughout the year is the issue with leverage ratio and holding Treasuries that is discouraging some banks from holding as many Treasuries that may affect the functioning of the marketplace. Is the Fed likely to address that issue in the new year?
I really don't think so. And I think that's unfortunate, because artificial constraints on the Treasury market work against the objective of liquidity. But I do believe all the banking agencies are steadfastly committed to a leverage ratio, which basically imposes a capital surcharge for holding the safest security you can hold. And treating it as the highest risk loan and treating those comparably really, again, is an artificial approach.
One of the areas of the markets that we at Bloomberg cover more and more as time goes on is so-called private credit, because as I understand it, because of some of the good and sufficient regulations from the great financial crisis, a lot of the credit has moved over to the private side, which may be a bit more opaque. What are the risks as we see interest rates rise, because it looks like the Fed's going to keep raising, at least for the time being, that there could be some cracks develop that we don't even understand fully on the private credit side?
Well, once again, it's an informational issue. Who knows what is there? And I think one of the problems going all the way back to 2007 and 08, that nobody really knew what the mortgage banks, the non-regulated segment of the mortgage system, held. and what the credit quality was. So as rates rise, and if they continue at a high level, there are the two impacts potentially on private credit. One is a higher level of defaults, and the second is the cost of funding goes up. So I return to the idea of information and disclosure being critical, at least to the government.
Finally, Rodge, 2022 was a rough year, I think it's fair to say, for cryptocurrency. That was even before we had the FTX situation. Are we going to finally get that regulation of crypto in 2023?
You know, I would certainly hope so. Admittedly, it's a fiendishly difficult area to regulate. But I've got to be frank and say that I regard the failure of Congress and the regulators to regulate crypto is just an abdication of responsibility. Humpty Dumpty is sitting on the wall, and we shouldn't wait for Humpty Dumpty to fall with the consequences which the nursery rhyme explains.
Yeah, all the king's horses, even you maybe couldn't put it back together again. But finally, you mentioned Congress and the regulators. Do we need Congress to act? Can the regulators do it on their own?
I actually think it would be preferable if Congress would act, because crypto does not readily fit into any of the existing regulatory schemes. And a more comprehensive approach would make more sense. Right. But I think the regulators can't just keep waiting for Congress. Right. And if Congress fails to act, the regulators must step in.
Rodge, thank you so very much for being with us. This is Rodge Cohen of Sullivan Cromwell.